about markets or anything else, but talk about where we're sitting with our clients and the conversations we're starting to have, and encourage you to be having these conversations with your financial advisors, or have areas that should be looked at. The end of the tax year is always a brilliant time to focus minds. Although we're only in mid-February, it will be here before we know it. It's racing by. Luckily, Easter falls after it this year. Next year we even get Easter in the middle of it, which is a nightmare. But with the changes that were announced in the autumn statement, budget, whatever you want to call it, we're a lot more focused on using our allowances this year, especially towards capital gains tax. And this is something that I think really is important for everyone that's got assets that will fall liable to capital gains if it's a portfolio or anything, to start having a look at that this year. This year you've got an allowance of 12,300, which is quite a good level of gains to be able to make. That is getting cut in fractionally over half next year. It will drop to 6,000, and the year after it's going to drop to 3,000, which it's going to become quite onerous on the gain side. The amount you pay on capital gains is still quite a low tax, and I don't know whether Nick and Chris will agree with me, but how long that will stay such a cheap tax, I'm not convinced by long term. Some tax alignment could well be seen at some point, so it's certainly worth considering. A lot of people don't look at taking their capital gains because we've had this allowance for so long. It's been a good allowance for quite a while, and a lot of people don't want to take the gains because they're going to be out of the market for a length of time with everything. But there are ways that you can go around it. So you can sell a share and buy it back into an ISA immediately, and that means that you're not out of the market for any length of time. You do pay a small spread on it, but it's insignificant in comparison to what the tax would be. Or if you haven't got an ISA that you can utilize, moving it into what we call the bed and spouse. So basically swapping assets between husband and wife. Very easy, very tax efficient, and it can be done. It has to be a sale in order to qualify rather than a gift. So you've got to liquidate it. That's a really easy thing. If you're thinking, oh, well, what about ISAs? A lot of people, we've still got our £20,000 ISA allowance. Don't think that's going to change at the moment. We're not hearing anything on that. But another deep conversation we have with a lot of people is the relevance of cash ISAs over stocks and shares ISAs. I come across a lot of people who religiously do a cash ISA every year and have a taxable portfolio of shares. We are actively encouraging people to move the cash ISAs in, move assets within capital gains tax allowances into the cash ISAs, and then take the cash out and have it in other forms of cash savings. You will then pay interest tax on any interest over £1,000, which you can get, but anything once it's in the ISA is tax and income tax free. So the gains are growing. So especially with the allowances coming down, that can be a nice thing to look at. And there are obviously places that you can hold cash as well if you want to hold a lot of cash out with an ISA that's also quite tax efficient, premium bonds, that sort of thing. Your winnings are free, anything you get from it, and the rates have started to go up on premium bonds, and they're also very well secured because they are backed by the government. So you're not limited by any banking finance figures there if the banks go under, which we don't expect. So that's something to think about. If you're looking to, or have got family, the children that might be looking to buy a property, and they can, have a look at the lifetime ISAs. Again, they can be used for first property or for retirement, and they get 25% government bonuses paid into them. Only a small figure can go in. I think it's 4,000 at the moment. Again, I haven't heard any changes on that. That's quite a nice uplift, and it's quite a nice way of, I know people use their 3,000 gifting allowance into that quite often for the kids or the grandkids, which is something nice. You can use it for pensions. They have to be open before you're 40. But again, it's a tax efficient savings vehicle, which can be overlooked. So if you've got excess income, there are penalties if you come out of them. So they're there for the long term, for specific reasons. If you want to get the 25% government uplift, they fine you if you come out for any other reason, 25%, which feels like they're taking their money back, but it's actually more than they've given you. It's a technical fine on it because they give you the 25. So there are a couple of really easy things. Also, ensure you're speaking to your advisors about your pensions. If you've got spare money, if there's anything there, pensions are very tax efficient. We can get money into them quickly and easily. They're also, if you think you're going to have IHT problems later on, they become very efficient for inheritance tax if you're not going to take the money out. Most of us can pay in up to our earnings. We can all pay in up to the age of 75, 3,600, whether we're earning or not. There is an upper limit of 40,000 for most of us. That there are caveats on that, depending on where your earnings are. And you can go back 3 years on getting money into there. So if you were doing sales of assets for capital gains tax, that might be a consideration. If you don't draw your pensions, they're also very good IHT planning, inheritance tax, sorry. So that's something else that's worth considering. That's the main bit of our conversations. Some people are looking, if they know they're going to be maybe selling properties or something next year or in the next couple of years and have got losses in portfolios, you can lock in the losses and they can get carried forward. Losses get used in the tax year before your allowance does. So don't lock in the losses and think you've got the allowance as well. The losses get used in the allowance, but it's another interesting way to look at things. And they're the three main ones. If you've maxed out all of your allowances and everything, but you still want some tax efficient vehicles, there are things like VCT schemes, EIS schemes. They carry very good tax efficient things. They're high risk, much higher, you're moving up to the next level of risk on these things, and your advisors can talk to you about that. And we look at these EIS schemes. If you have got CGT problems and you're able to take a higher level of risk with your money, can also be used to set off some capital gains tax. But it's certainly something, if you're in that position, to have a conversation with people. But I think one of the main things that I want to say, and I want to encourage everybody and encourage you to encourage everybody, is use these allowances. They've been massively, the cuts that have come into the capital gains tax have been quite painful going forward. We're really going to feel it. Different cuts might well be seen. We don't know. It's all very tight-lipped. We might know more on after the next budget. But with everything that's going on in the UK economy, where the UK debt is, money has got to be brought in, and these are quite easy wins to get rid of areas where people can put money into, and the realigning of tax rates as well could come along. So while we've got it, it's a good idea to use it. And if you do have any extra money, gifting is always a fantastic thing to be able to do as well. We do have allowances that we can look at for that, and you can make £3,000 gift exemptions without coming into any issues with inheritance tax rules or anything like that. So just areas to have a think about, to look at and see what you're doing, and take some of the easy wins so that more money can stay with you into them, and have a look. And that's a lot of what I wanted to say. The other thing that I got on my notes to point out is the dividend allowance. We've all seen that the capital gains tax allowance is getting cut. The dividend allowance is dropping as well over the next 3 years. So it's going from 2,000 to 1,000 and then down to 500, which again, that's significant changes in where you're going to pay tax. What else? Pensions as well. If you do make pension contributions, that will reduce what your taxable income is. It comes out of that top line. So if you can use it to keep below some of the higher levels where you start getting stung on things. If you are at the higher end, the sort of the close to the 100,000 and above, it does help you keep out of the 60% tax trap, which we forget about a little bit, that one, but if we use that, it's quite a nice little way of reducing what our allowances are. And that was a lot of what I wanted to say. It was sort of very brief and to the point, but they're the main areas. And we're obviously, if anybody wants more detail on that, speak to us, speak to your accountants. We're all there and all encouraging these sort of things to go through. And it's a good thing to be looking at.
Thanks very much, Helen. Thank you. Just thought it was a useful opportunity to remind people what they should be looking at towards the end of the financial year as we come up to that. Anything, Nick, in terms of, or any questions from anybody in terms of what they're doing, or Nick, any observations from your point of view about tax?
Well, I agree with everything that Helen said, and I think there are still these ridiculous tax traps that people get caught out by, earning over 100 grand, earning over 50 grand. Particularly, I had a case this week with somebody who's got children, and you'll all be familiar with the fact that if you've got child benefit, you get your child benefit abated if you earn over 50 grand. So it was this most ridiculous situation where, you can have a married couple earning 49,999 each in a household, but if you've got one earning more than 50 grand, your child benefit gets abated, and it's very frustrating. And this client of mine had got a promotion, and you also get an abatement on your free hours from the government. You get 30 hours, and your kids are small normally, but as soon as your income goes over 100 grand, it gets abated down to 15, and that's worth, she worked out, it's like £270 a month of childcare. So, it's just, the government's got some ridiculous thresholds. So for her, we were looking at salary sacrifice because it's the obvious thing to do, because it saves the employer national insurance, it saves her income tax, and will save her the 30 hours as well. So I do talk to clients quite a lot about salary sacrifice as a way of dealing with their problems in those bands, and this person actually, as it turns out, was quite keen on having an electric car, and for low emission vehicles you can salary sacrifice as well. So that for her, she was going to be earning 125 grand, so right in that spot where she's paying 60% tax, losing all her benefits. So by salary sacrifice for pension and a tax efficient vehicle, she saves all that. So that's really good. And yeah, the change to the government's thresholds to reduce these limits are going to be a real challenge for people, brokers, to try and keep within their annual exemptions. And I agree that 20% tax is not the end of the world really at the moment. I think there is speculation that will go up. There has been for ages, but when it will happen, I don't know. But I think I've certainly got clients who are, where they can, accelerating capital transactions, sooner rather than later, both on the corporate side because of the increase in corporate tax rates, but also on the capital gains side because of the concern that might go up. I mean, I don't think there's a lot of appetite to make a lot of more negative tax news before the next election. So I'd be surprised in a way, but I think everything's up for grabs at the next election. So interesting to see what happens. And the lowering of these exemptions is not great because it's bringing more and more people into self-assessment. So it's going to add a huge amount of burden on the revenue to kind of manage all that. So I just wonder whether some of that stuff will get reversed. You know, certainly the ones of the year after next. But that was my thoughts.
That's good.
Yeah.
I just wanted to, one thing that I'd forgotten to say is that obviously if you're a trustee on a trust, I'm starting to have a lot of conversations with my trustees about actually how much gains they're going to be willing to pay. Otherwise, you're not going to be able to manage it. It's going to become impossible because they're really getting slashed. They're low to begin with, but it's getting even further.
Yeah, I've got on the trustee side, I do have some like grandparents trusts where they've set, you know, things up for grandchildren, and the general approach that we've had with those is actually pointing out shares that have got high gains on them so that the individuals cash in the gains in their own names to use their own allowances. So, but I agree on a larger trust where, you know, it's impossible to manage within that exemption. It's very difficult. But it's an interesting point you made also about capital losses, because there's no point realizing losses in a year where you've got an annual exemption. So you need to make sure that if you do realize a loss, that you, in a year where you've not used your annual exemption, then try not to realize a gain in the same year. Kick it down the road to the next year if you can. But in reality, I think most brokers try and use up the annual exemption with losses as well, I think.
Yeah, it varies. We have the odd years where we will just make losses. It's not been quite that bad this year.
Last year.
I was going to say 2020 was a brilliant example of doing that.
Yeah. And actually, we've got some clients who you know, problem with losses, you can't carry them back. So I've got clients who've got a gain, you know, they've got a company that's maybe not doing so well, and they think that they're going to realize a loss on liquidation. Well, they can't. You can actually make a negligible value claim and accelerate the loss in those scenarios. So if you've got a gain this year that you can't offset with a loss on an asset that's become of negligible value, and a good example is people who have invested in EIS shares or something like that, you know, you can accelerate the point at which the loss is realized, which can be useful.
Anybody got any questions, observations around what they're doing in their businesses or anything else they want to, and on to that, we'll pick up on some of those things. And it'll be interesting, as you say, it's difficult to guess what's going to come out of the budget. I'm sure it will all leak out beforehand, but not so much at the moment, maybe. But we can pick those up after the budget as well in March. Chris, from your point of view, in terms of corporate customers and your clients you're seeing?
Yeah, no, I think morning everyone. Yeah, I just no real change from sort of, you know, last month really. I think it's still sort of a I have to say, talking to clients in different sectors, they're going through different pains, they're going through different opportunities. It's a real mixed bag actually. One of the things that most of our clients are seeing is that there's still a lack of people. They still need people. So it'll be interesting to see what the recruiters on the call are seeing in the marketplace in different sectors. So we have seen in the press quite a few of the very large businesses sort of, you know, announce redundancies and stuff like that. I'm not sure that's actually sort of flowing through to the smaller sort of entities unless they're in specific sectors. I think there's probably in those big groups a lot of how can I put it, a lot of fat within that employee group where they actually just they've probably employed a lot of people over the years, and then they've actually realized and tried to work out what those people are doing and whether they're actually, you know, and they're using this as a reason to sort of thin that out, I think. So that is a worry for those individuals, obviously, but I think I wouldn't say that's across the board that there are, you know, there's not a whole scale, you know, in my client base that going through redundancy programs or anything like that at the moment. I think the skill set is still missing in places. I think that's a concern for people. But, you know, on the positive side, you know, the Bank of England have said that the interest rate's not going to go quite as high. it's not quite so negative in the press, which always helps. I think there are certain sectors that are really, struggling or are going to struggle, and just at the start of that, probably property and construction, particularly retail has been very good actually, sort of up until Christmas, January, speaking to a few of my retail clients, okay. But they're still very worried about what's around the corner. They don't really know. But yeah, it's, the press, the inflation's gone down a little bit. And that was announced this morning or yesterday morning, I can't remember. So I think, most economists in the room or sort of outside think that inflation will be halved, no problem. That's why probably the government said that they could achieve it, because I think naturally it will happen anyway. So, yeah, I think 2023 is going to be hard. But I think every client that I'm speaking to pretty much is saying it's not as bad as they thought it was going to be 3 months ago. But they're still concerned and still holding on to cash and still being a bit mindful about making any big decisions. So, and I think that's still the case, and I think that will still be the case for the next 6 to 9 months, in my view. So.